Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 19th of June. I'm Daniel Lam, your host for the podcast. Summer holidays for the kids is coming up, and many of the colleagues are talking about taking their family to Japan. Now, the yen keeps getting cheaper against the Hong Kong dollar, which is pegged to the US dollar, after the Bank of Japan meeting last Friday. So the BOJ kept its policy rate unchanged and maintained the pace of bond buying at 6 trillion yen per month, but it signaled that it will lay out a plan to reduce its balance sheet next month, without offering any details about timeline or scope. Governor Ueda also signaled a rate hike in July remains a possibility. Now, the market took this as an extension of the cautious move from the BOJ. Remember, I always said that the BOJ is erring on the side of caution and would rather keep monetary policy on the easier side of things, after having just exited a 30-year of balance sheet contraction. Now, although a weaker yen would push up import cost, the central bank needs demand-driven inflation to cement a case for further rate hikes. Notably, Ueda had hinted that evidence of a virtuous cycle of rising wages and rising inflation would give the central bank the confidence to normalize policies. However, real wage growth remains negative, and the recent economic data have been mixed. Nonetheless, after some likely short-term weakening, the yen may strengthen against the US dollar over the medium to longer term. So we see likelihood of the dollar-yen heading towards the higher side of the 150 to 160 range in the near term, before strengthening to the lower end of the range. Well, we believe that the interest rate differentials will turn in yen's favor, even if the BOJ does not tighten policy aggressively. And that's given that major central banks around the world have embarked or are about to go into a dovish pivot. So as a result, we believe there's still room for the Japan domestic stocks to do well, especially those in the financial sector, where the companies are likely to benefit from a steepening yield curve. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.